Hello, everyone, and welcome to the first time homebuyer class by CosaLoans.com. My name is Denny Troncoso, and I'm the founder of Cosa Loans. I'm a licensed loan originator, and I'm a former personal financial advisor. So I used to help people with insurance, debt consolidation, and also planning retirement, college planning, etc. Now, I've worked in the real estate business for over 20 years, working in finance and investing. I do own some rental properties, and have been able to build a portfolio, and I'm also a real estate developer. And I have a master's in real estate from UCF, so go Knights. I'm a homeowner, and like I mentioned, I've been investing in real estate since 2010. Now, my personal life, some of the things I'm into is I'm a coach. I've coached my son's t-ball team, soccer team, so I enjoy doing those things. I'm also a mentor, whether it's at UCF or through a program called Take Stock in Children at the local high school, something I enjoy doing there. And the other thing is I am a member of Toastmasters. I've been a member for about 5 years or so. I enjoy reading. So I'm a big bookworm. So if you love to enjoy reading, and that's something that I love chatting about, and variety of subjects from history to business, personal finance, biographies, and even science and psychology. I was born in the Dominican Republic, so my family came here when I was 3 years old, moved to New York City, kind of where a lot of Dominicans arrive, and then we moved to Florida. So I grew up in Florida. I'm officially a Floridian, been here for over 25 years. And I do speak Spanish, yo hablo español, and I speak a little bit of French, un peu français, c'est un peu, très mal. Now, today I'm going to talk about lending and home ownership and how you can own a home one day. And why is that important? Because home ownership is the biggest investment most people make in their lives. And it's the number one way to build wealth in the United States. Of course, building a business, and that's probably a great way to build wealth and to build lots of wealth. But the average person is not going to be an entrepreneur, but the average person could become a homeowner. And I'll be able to show you how you can accomplish that goal today if that's something you'd like to do. Now, is it worth it? Well, I talked about building wealth. There are benefits to owning a home, and there are challenges as well. But some of the benefits are a stable housing payment. So when you rent, the rent at this time, it could be in different markets. It could be lower than what you're paying for home ownership, but your rent could go up in the future. The landlord could increase the rent, costs could go up, etc. Where if you have a mortgage and you have a fixed mortgage for 30 years, your payment will stay fixed for 30 years. Things can change like insurance and taxes, but your mortgage payment, interest and principal will always stay the same. There's potential growth in wealth through the home's equity. So as you pay down the principal, you are going to build equity and you'll be able to grow your net worth. So the home value is 100,000, you borrowed 100,000 or a little less, but then every month, every year, you're paying it down. And one day maybe it'll be at zero, right? And then you still have that $100,000 asset, or maybe even bigger if it grew in value. Now, there are potential tax benefits. When you rent, all that money that you pay, you can't deduct it in your taxes, technically. But if you do own a home, all the interest that you pay, you can deduct that in your taxes. So that's a big benefit toward home ownership that the government has set up. It's actually encouraging home ownership. Now, there's also the potential to live free when the loan is paid off. Like I said, if you took the loan 30 years or you paid it off even sooner, now you have a home paid off. You don't have a mortgage payment. You just pay your taxes, pay your insurance if you want to, because insurance is not required technically. And that's it. So you have a little bit of financial security there where you don't have to worry about a payment. And this can work in investments too. And then the last thing is also there, maybe you want to do a reverse mortgage. So you're like, you know what? I want to have money coming in, my retirement, I didn't save enough, or I want to have a nicer retirement and I want to get paid 300, 500, 10,000, depending on the value of your home, $1,000 a month, or I want to get money out, but I don't want to have to worry about a payment. That's a reverse mortgage. Not going to talk about that today, but that's just another option whenever you have your home paid off or you have a lot of equity. And the last one is your ability to pass the asset to your family or your heirs. So now you're building a legacy, right? So you have grandchildren, you have great grandchildren, kids. Maybe they didn't own a home, but you owned a home, and now you can pass it on to them so they can live. Or now maybe that home can be an asset where they can sell it, and then they can use that for different things, building a business, investment in a business, or college education, or so many other things that you making that decision can do. Now, like I said, there are challenges. So you have to buy in the right market. There are some expensive markets around the United States that, unless you're making a large amount of income or you have a large down payment, it may not be worth it to buy a home. So it is market specific, but you should analyze that, because over the long term, it is a good investment to own real estate. Now, today I'm going to talk about a lot of different things, and the first thing I'm going to talk about is team members, and some of your top team members are: number one, your mortgage broker or loan officer, which is me, and then your other top team member is your real estate agent or realtor, right? Now it's a different thing. To become a realtor, you have to be part of the Realtor Association, the National Realtor Association. Now, not all real estate agents are part of that, but that's actually a good thing that to be part of, because it requires there's a code of ethics and a lot of other benefits there. Now, another team member may be an attorney. When you're buying an expensive asset, maybe you want to have someone to review those documents for you. Real estate agents have a contract that they use, that it's approved by some attorneys that they use, but sometimes things can get complex. You want a little bit more security. You can hire an attorney to do the contract work. In some states also, attorneys handle the closing. So that's another thing. Inspectors are going to check the property for the condition of it. If you're buying a used or new home, it's always a great idea to hire an inspector, because some homes, they have problems, whether in new construction, something got missed, something didn't get installed properly, and a good inspector can identify those things. And then also, if there's some type of wood rot, is it a problem with termites, or is it a problem with some type of other infestation? They will be able to know that. It's called I'll be able to talk about that inspection as well. The next one is an appraiser, and the appraiser actually is going to value the property to make sure what you're buying is worth the value that you're paying, right? Now, they do work for the bank, but they are part of the team, because if a value comes in, let's say at 150,000, you're paying 200,000 for a home, and you're getting a loan for that amount, they're going to say, no, that loan won't qualify. So that's actually protecting you as well. The next one is a title agent, and in some states it could be an attorney. But this is the person that protects, it offers your insurance, where if someone comes and says, no, I own that property, I'm the real owner, I'm on the title, they're going to be able to insure and protect you by that mistake. They do a search, and I'll talk about that later on how they protect you. And the last person is your insurance agent. And the insurance agent, we're talking about just hazard and liability insurance, and this is in case there's a fire or someone falls on your property and you have to pay a claim there. So let's talk about the lender, which is me, and this is one of the most important team members. And it's not just because I'm me. I know I'm biased, but it really is important. It's really the first person you really need to talk to. So who are they? Who's the lender? Well, the lender is a person that's going to give you the money to buy a home. Now, few people can buy a home cash, right? Because homes are an expensive asset to purchase. But the government has set up lending options that you can buy a home, and it makes it very realistically achievable to buy a home. Not every country is like this. Some loan terms are much difficult in different countries. In the United States, it's a really good option. You have FHA, you have USDA, you have a lot of programs that I'll talk about. So this is the first person you talk to, because you want to know how much you can afford and how much you can qualify for. And most people start with a real estate agent, because nobody really wants to do lending. They want the home, right? But you can't get the home unless you have the money. So this really should be the first person you talk to. Now, my job is to get the loan approved so you can buy your house, right? So help you go through this process, guide you through it, organize the paperwork, look at lending options, and get the loan approved, get it closed so you can move in, right? Now, the first key is to really find a trusted lender, because there's different types. There's banks, Chase, Bank of America, Wells Fargo, some of the larger banks you can go to a credit union, you can go to a community bank, can do a loan. Now there's correspondent lenders or direct lenders. This is kind of like a small like lending company where they have maybe 10 investors or 10 lenders that they work with. They approve the loans in-house, and you can work with them too. And then the last one is a mortgage broker. A mortgage broker, which is what I do, is I work with tons of different lenders, hundreds of loan options, and I can compare. And sometimes it works out well because I can compare and find flexibility when people need flexibility, because everybody's finances are different. Sometimes they have something on their record, and one lender may work great with that, and another lender won't. So we can look at all those options. Now, starting the finance process, I always look at, like, let's say you're gonna buy a car. What you should do is you really start out with a budget. Instead of saying, you know what, you go to a lender and say, how much can I qualify for? Well, because of your income, maybe you can qualify for $1 million. But the payment on $1 million could be, I don't know, $5,000 a month. Do you really want to pay $5,000 a month? Probably not. Maybe, but maybe not. So what you want to do is you want to start out with, how much money do I want to put down? It's like, okay, I have some savings, but I want to have some reserves if I buy a house. I can put aside 50,000 or 100,000 to put down. Okay, great, check box. Then you're like, well, I need to pay closing costs. How much money can I put aside for that? Well, let's say closing costs, I can put aside 10, 20,000 for that. So now you have, let's say you said 100, now you have 120. Then you have estimated total cash out of pocket. So you have 120,000 and you have your reserves, and you're like, okay, what is the maximum I want to pay per month? You're like, well, I don't want to go over 2,000 or 2,500 or 3,500 a month, right? It just depends on your income. So now we can work backwards and say, well, if you don't want to go over 3,500 and you're going to put so much money down, you should really stay at a house price of X. Could be 400,000, could be 500,000, whatever it is. But we want to work backwards, right? And find out what you want your budget to be, and then work from there to find the price of the home and the mortgage that you want to qualify for. I know a lot of people start out the other way. Just want to educate you there. You want to look at that and look at the budget first. Now, what are loan requirements? Well, when you're going to go out and get a loan, you need to put a down payment. There are closing costs. So there's some fees that you have to pay to close a loan, pay to the city, pay to the title company. We have a fee that we charge for doing the loan service. You need to pay the lender. You have to pay closing costs. Now, another thing that they look at the lenders is there's the debt to the income ratio. So they're going to look how much monthly debt you have. They're going to look at all your credit cards, all your personal loans, your car loan, anything else that you owe, how much do you pay per month? And then they're going to look at your income. And by doing that, they're going to see what your debt to income ratio is. And I'll talk about what the percentage is that you should stay under so you can shoot for that. And that's something I can also help you with. Now, the other thing that they're going to look at is your income history. Do you have a job? Do you have a business? How long have you had it? How long have you had your job? Typically, they're looking at 2 years of employment. There is some flexibility with that, but typically that's the goal, 2 years of history in the same area of business and the same career, etc. And then the last thing is credit. And when we're talking about credit, we're talking about score and we're talking about credit history. So you want to have a highest credit score as possible. Now there's some minimums, and I'll talk about those, but you want to just meet those requirements. And then you want to make sure that certain things on your credit have passed, like foreclosures, bankruptcies, etc., or repossessions. And we'll talk about that later. Some loan terms to be familiar with. So I'm going to talk about a lot of stuff, but these are some things to be familiar with. And you can rewind this video if you'd like, so you can become familiar. But just something when you're having conversations with your lender, when you're having conversations with your real estate agent, these are some things you want to understand. And that way it'd be easier for you later when you're going through the process. The first one is principal, interest, taxes, and insurance. They typically call it PITI, just for short, which just encompasses that. The next one is private mortgage insurance. Private mortgage insurance is if you're borrowing more than 80% of the loan. So let's say it's a $100,000 house and you're borrowing 90,000, you're going to have to pay private mortgage insurance because you're borrowing more than 80,000, more than 80%. That protects the bank in case of a default, because you're unable to pay and they have to take the house back. The next one is homeowners association, HOA. This is some neighborhoods may have a homeowners association where you have to pay. It could be $50, could be $100. Could be 150 a year, 100 a year, or even $200-300 a month, right? Depending if they have a lot of nice amenities. If it's a private community, senior community, You just look at that, and that goes into calculating with your mortgage payment, right? They put all that together. And the principal and interest taxes and insurance, that kind of speaks for itself. A principal is the amount you're paying down in the loan. The interest is the amount that the bank is making, the money that they're making. Taxes is property taxes, which you're paying to the city, the government. And insurance is that hazard insurance I spoke about earlier. So I want to make sure to mention that. And then the last one is total monthly gross income and equals pre-tax income. That's the money that they're looking at on how to calculate your debt to income ratio. So if you make, let's say, $20, $30 an hour, they're going to base it on that. And then your net is, they don't really look at that. They're looking more at the gross, right? Unless, you have other things, other expenses in there like debts, child support, etc. All right, so let's look at other loan terms to be familiar with. And this one is a fixed rate, which that's really what you want, unless you're an investor or unless you're buying and you're not going to hold the property for a long period of time. Maybe you can look at an adjustable rate mortgage, which is below. They call those an ARM for short, adjustable rate mortgage. Fixed is a mortgage is going to stay fixed for 30 years, right? Adjustable rate mortgage could be a mortgage that's going to stay, it's going to adjust every so often. Could be a year, could be 3 years, could be 5 years, 7. There's a lot of different options, but it's just not going to stay fixed for the whole loan, right? The next one is a balloon payment. And a balloon payment is something that may not, let's say the loan is a 30-year loan with a 5-year balloon. Really, at 5 years, that means the loan ends. So that means you have to get a new loan to be able to stay with that, keep the property. If not, you would have to sell the house. So that's something. These are some things that were happening back in 2008. Not very common now, but still used and mostly a lot by investors, etc. So just be familiar with this whenever you're out there getting a loan. Typically for a first-time home buyer, you want to stay away from a lot of this, right? Keep things simple. The next one is prepayment penalty. Again, this is if you get a loan and they don't want you to pay the loan off early. Maybe you want to pay it off in a year because interest rates went down, or 2 years. You want to look at loans that don't have a prepayment penalty. Again, typically now loans, when it's FHA, conventional, USDA, they're not going to have those things, but always something to be aware of so you can be informed as a borrower. And then the last one is discount points. They also call it loan buy downs. And this is when interest rates right now are around 6-7%. And you could buy the loan down by paying to get a 6% or a 5% loan. Now it's pretty expensive, but you can do it. You just have to pay that interest up front. So that's just something else to be familiar with. Now, what are closing costs? The closing costs are the money or fees to close the loan. Money or fees to close the loan. At the end, you got the loan approved. It's time to sign the paperwork that you're getting the loan, and now you have to pay some fees. The government gets some fees, etc. Those are all government fees. Okay, those are it could be closing costs. Right, not all of them are the government. Could be appraisal, our lender fee. All those things are closing costs, right? Now, an example: your home is 100,000. Closing costs on average could be 3 to 5%. So that means the closing costs are going to be between $3,000 and $5,000, right? Now, what are ways to get help with closing costs? Because you don't have to pay them yourself. Let's say you can't, and you still want to own a home. There are ways to get assistance. It gets a little more challenging, but it's possible. And right now, the way that the market is, it's more realistic, because when it's a seller's market, it's harder. Now, it's seller concessions or seller credits is number one. And this is when you're working to buy a home and you're making an offer. In the contract, you ask the seller, hey, can you give me back a certain amount of money for closing costs? There are some rules with that. So you want to work with your lender, because the lender sometimes limit the amount that you can get. Not me, but the government. There's some rules with that. So I want to be able to tell your real estate agent when they're doing the paperwork, how much do they want to ask for, right? And then the other one is, so the rules right there are for FHA, conventional, and USDA, it's 6% of the purchase price. And then VA, it's 4% of the loan amount, right? So of the loan amount. So just be aware of that. And then you don't have to remember all this, but just want you to be informed. All right, now what is a down payment? The down payment is the money you have to contribute toward the purchase. It reduces the amount you want to borrow. So example, if the house is 100,000 and you're putting 20% down, your down payment is 20,000. if you take the 20,000 off of the 100,000, you would only borrow 80,000, right? So down payments could be 0 on a USDA loan, or they could be 20% or more. So you can put 40% down, 50% down if you want to have a lower payment. Now, where can the down payment and closing costs funds come from? Well, they can come from a lot of different places, but some of the basic ones are your checking account, savings account, investment account. We're going to need 2-month bank statement for that, all the pages. You can't just have it under your mattress and say, hey, I'm going to use this for my down payment. Go ahead and deposit that money down now, start getting in order. Give me a call, let's chat, let's get things done the right way. So cash deposits are not available, must source all large deposits. So the bank is going to ask, where's this money coming from, right? If you just deposited money or send money in. Retirement accounts, they're going to ask for that. 401ks, 403bs, IRAs, you can get the money from there as well. Other places, it can be a gift from family members, close friends, an employer to your job, a charity, or an employer union. They can give you a gift. It cannot be a loan from them. So they can't let you borrow money so you can put as a down payment. It has to be a gift. And we're going to request a gift letter that they're not requesting the money back, right? So that's something just be aware. Now, the gift funds are not allowed from your realtor, the seller, the lender, the home builder, or your mattress. So be aware of that. The seller can't give you a gift to buy the house. They can give you seller credits, but that's where it ends. Right? They can lower the price. You can work that out there, but it can't be, hey, I'm gonna give you seller credits and I'm gonna give you 20,000 for your down payment. Can't do that. Now, down payment assistance. There's programs around the country that provide assistance for your down payment. There's resources like national organizations, local housing authorities. So every typically county has a housing authority. You can contact them and ask, hey, do you have funds available for down payment assistance? They may be able to have funds that you can use. It could be a gift, or it could be a loan, or they structure it different ways. Those can be loans, right? If some of them, they're called bonds, maybe you don't have a payment right now, maybe it gets paid later. So that can be done. Nonprofit organizations are another one. Sometimes they have funds available for down payment assistance, and for-profit companies. Some companies are helping, like banks, Wells Fargo, and you don't have to do the loan with them. They do have funds available. You just have to maybe take a class, etc. Now, some of these funds, they don't just give it to you and then you can sell the house next year and keep that money. You have to live in the house for a certain amount of time. So it says that it's forgiven. It could be in a 5-year period, 10 years, 25 years. And then some programs are no or low interest loans, right? So just that. And some programs may be income based. You can't make over a certain amount, or they may not be. Let me just be open for everyone, just applying. And then we'll give you an example. So let's say you're getting a conventional loan, you're buying a house, the price is $334,000. The minimum down payment is $10,000, which is 3%. And your typical closing cost estimate is $10,000, which is another 3%. The expected cash to close is $20,000. But now you're getting down payment assistance of $10,000. So that means you would only need $10,000 to close, right? So it makes the home purchase easier to achieve. And that's what these programs are for, to help people achieve home ownership. Now, down payment assisting is typically for first-time home buyers. So what is a first-time home buyer? It is a person that hasn't owned a home in the last 3 years, right? So you cannot have been on title, whether it's your home or someone else's home, for the last 3 years. If it's been longer than that, you can qualify for down payment assistance. Typically, if it's home buyer, first-time home buyer only, then you have to meet that requirement. Now, what is a debt to income ratio? We're a debt to income ratio, DTI for short. And then can you afford to pay your mortgage and debts? That's what they're looking to know. How much are you making and how much are your monthly payments? What are other debts? Your credit card, your student loans, your car loans, your personal, they're looking at all those things. And then they come up with the front end ratio, which is not your mortgage. It doesn't include the mortgage. And then they also look at the back end ratio, which it includes your mortgage. So they're looking at those two ratios, still the debt to income ratio, the front end and the back end. Front end, they don't take account the mortgage. They just look at all your debts. And they don't look at utilities. They don't look at technically cell phone payments. They don't look at groceries. They don't look at all of it. They're just looking at debts. Credit cards, student loans, car loans, personal loans. What is the back end ratio, right? Then that's when they take into account the PITI, the principal, interest, taxes, insurance, HOA. They put all those things together. The private mortgage insurance we were talking about earlier. So what does the mortgage payment include? I put PITI and the HOA, mentioned that. Now let's go over an example. DTI, the front end ratio, is only your debts. Example, if your monthly debts are 1,000, car payment, student loan, etc., and your income is 10,000, you take 1,000 and you divide it by 10, you get a 10% debt to income front end ratio, which is great, right? Because you're making 10,000, you're only spending 1,000 on your debts, right? The lower the better, but that 10% is really good. Typically, they're looking like less than 28%, right? So 10 is really good. Now, the back end ratio, an example would be if your monthly debts are 1,000 and your new mortgage is 2,000, they add those two together. So 1,000 plus 2,000, that equals $3,000 a month. And you take the 3,000 and you divide it by the $10,000 in income. Now you have a 30% debt to income back end ratio, which is great. Want to stay hopefully below 34%, but some programs you can go up to even 45 or 50%, just depending on the situation. All right, but hopefully, again, the lower the better here. What are the max back-end DTI ratios allowed? FHA, they can go to 55%. May require more down payment, maybe some other things need to be done there, but that's possible. 45% on conventional, 41% on VA and USDA, right? 41% UA. And I'll talk about each program a little bit in a few minutes. Real quick before we go, I know a lot of people have student loans, and student loans are calculated in a specific way because sometimes people are not even paying anything. For a conventional loan, income-based repayment plan is based on 10% of your income, right? So let's say your income is 10,000, they're going to base the payment on 1,000 a month. And FHA and USDA loans are going to calculate it based on 0.5% of the loan debt. So let's say you owe 100,000, they're going to look at 0.5%. I put an example, 50,000. They'll look at 0.5%. That's $250 a month, right? Just wanted so you can be informed on how some of these things are done. So now let's look at qualifying income. And so you need to make money to buy a home. Now, there's two types of income typically, which are employee or self-employed income that we look at. And an employee, they're looking at a tax return and they're looking at W-2s for the last 2 years, right? I put here, you can approve a loan with a job offer letter. Let's say you went to accounting school and then you're a CPA now, you're going to get a job, you have a job offer. We may be able to approve the loan with the job offer letter, but typically looking at 2 years of income history. We're looking at pay stubs for the most recent 30 days, and we're looking for a written or verbal verification of employment, right? So we want to get that from the employer. Then if you're self-employed, we're looking at tax returns for the last 2 years, business or corporation, where you're looking for a year-to-date profit and loss statement and balance sheet. So your financials, your accountant prepares this, maybe you do it yourself. And then the last thing is we want a verification of your business license or CPA letter. Now let's talk about the credit score minimum and waiting periods. Credit score minimum waiting. So credit score requirements. If you're doing an FHA, this is a government program through the Federal Housing Administration. Your minimum credit score needs to be 580. We can do loans lower than that, but it's going to require a higher down payment. Typically, the down payment for FHA is 3.5%. It's a great program because it gives borrowers a lot of flexibility if they want to put low money down and they have a lot of debts, right? Now there's another program called, there's conventional VA and USDA. The minimums are 620. Again, we can do lower, may require larger down payments. Conventional is a program that is not government-based, it's really more like private banks. VA is Veterans Administration. These are government loans for veterans or their spouses, depending on the situation. And USDA loans are loans for areas that are considered rural. They're outside of the main cities, they're outside of suburbs, they're further out, and they have great loan terms which you don't have to put any money down. Now it's possible, but there are income requirements here. So not everyone can get those unless they meet a certain income, lower income. Possible to close with lower credit score. I mentioned that. Now, there are waiting periods. So if you had a bankruptcy, you have to wait 2 years before you can get a loan, right? A typical loan. Now, let's get on the right path. Let's chat. And there's a lot of loan programs, maybe investor loans, etc. Maybe we can work something out if you're looking for investment property or something different. But typically, it's a 2-year waiting period. If you've had a short sale or foreclosure is when you lost the house and the government, the bank took it back, or if it's a short sale, you had to sell it below the loan amount, the bank accepted a lower price, then you have to wait 3 years. So how long will negative items remain on your credit? 2 years or less for credit inquiries. That's when considered hard pulls. There's also something called soft pulls that, like, if you're getting insurance, those don't affect you that much. And then also as lenders, we can do a soft pull, which is to get you see where your credit is and maybe find ways to improve it before we do the hard pull that will affect it. So those stay on your credit for 2 years, then they fall off. They typically affect your credit somewhere about 5-10 points. 7 years or less are late payments, collections, judgments, settlements, foreclosures, repossessions, release tax liens, and charge-offs. So stay on your credit for 7 years or less. So just be aware of that. Try not to make any late payments if they stay on your credit for quite a while. I always put things on automatic just to avoid it. The next one is 10 years or less or Chapter 7 bankruptcy, Chapter 13 bankruptcy, and state tax liens. And then indefinitely are federal student loans in collections and federal tax liens. One thing I'll mention about credit inquiries is that, let's say you're shopping around, if you do it within a short period of time, a week, 2 weeks, all those inquiries won't affect your credit the same way as long as you do it within a short period of time, right? So you can shop around and have your credit pulled. If you can share your credit score instead, better, but just so you're aware. Now, how are credit scores calculated? 35% of your credit score is going to come from your payment history. How have you paid your payments? Are you paid them on time or have you paid late? 30% is going to come from the amount that you owe compared to the amount that you can borrow. So example, if you can borrow 1,000 and you're only borrowing at 300, you're below the 30%, you're at 30%, which is great. But now if you're borrowing 900 and you can borrow 1,000, you're at 90%. So that's affecting you negatively, right? So that's where it comes from, and that's how it's calculated. 15% comes from the length of your credit history. So the longer your history, that comes with 15%. Then 10% is from new credit inquiries. So if your new credit inquiries are coming in, that affects your credit 10% only. Just be aware of that. And then the last one is credit mix. So they're looking for, there's 2 types of credit. There's revolving and then there's installment. Mortgages, car loans, personal loans with a fixed payment, installment. Credit cards, revolving, right? So that it can change every month. You can take money out. Home equity line of credit, revolving. So you want to have a mix of credit. What mortgage program is right for you? Well, I talked about the Federal Housing Administration, 3.5% down. Conventional, 3% down, can be 5 or 10 or 20% down. Veterans Affairs, 0% down for veterans. United States Department of Agriculture, if you're buying in a rural area, your income qualified, 0% down, could be great. And the last one is jumbo, right? So this is for larger loan amounts. Can't remember what the number is right now, but I think somewhere around 700,000, and it depends on the market, right? Down payment is less than 20% minus private mortgage. If you're putting less than 20% down, private mortgage insurance is required. So just be aware of that. And that's just another cost that gets calculated in your debt to income ratio. All right, but what are the funds needed for closing? Well, you need to have a earnest money deposit, which is the deposit you're going to give. It's going to typically be held by the title company, but it's basically showing the seller, hey, I'm serious. I want to buy your house. I'm going to put $1,000. I'm going to put $5,000, $10,000 down, or like as a deposit, just until we get to closing. That money is going to be used at the closing table. It gets credited to everything, right? So let's say you put $1,000 as a deposit, earnest money. Then at closing, they say, okay, hey, they had already put $1,000. We're going to use that for the closing costs or for the down payment, however you want. Then there's an inspection fee. These are funds needed that you'd have to pay before. You got to pay the inspector. And then the next one, you have to pay the appraiser, right? Because they're going to do all these things before the closing is done. So just know that you have to have that money ahead of time and ready to go. Just so you're not prepared. You're like, oh my God, I need to pay $1,000 or $2,500 for earnest money. Plus I have to pay the inspection. Plus I have to pay the appraisal. Have it all. You're already kind of mentally prepared. What are some of the documents to lender? I mentioned some of this, but you need a pay stub, 30 days, bank investment account statement, 2 months, and the loan application to obtain your credit score. So you got to fill out an application. It's like anything else. Documents from the lender. What am I going to give to you as a lender? You're going to get a pre-qualification letter. It's an official letter, so you can give to the real estate agent. And then when you're submitting an offer, you can show it to the seller. Hey, this person's been qualified. They're ready to go. Right? You're going to get a loan estimate. This is going to show all your costs, your expected monthly payment, the expected cost, everything for the closing. It's going to be pretty close to accurate to when you get to the closing table on that property. The next one are other disclosures, truth in lending, how much interest you're going to pay over the life of the loan. And then at the end, before closing, you're going to get the closing disclosure, which is talking about the final numbers, right? So these are just some documents to be familiar with and be prepared to receive. Now, what does the loan process look like? Well, first you get the pre-approval, pre-qualification. We do that. Then you go house hunting. Go look for houses. I'm telling you, it's a process. So it can take 3 to 6 months on average to find a good home. You go out with your real estate agent, you go out, look for property, submit the offer, get it accepted. Then you're entering escrow, right? You put the deposit, the escrow deposit. Typically takes 30 days from start to closing. Once you get to escrow, let me move this up here. Then we go through underwriting, right? If we have all your documents, it goes a lot faster. We close a loan in 20 days, right? It just depends on the appraiser. Loan gets approved. Hey, we're ready to close. Close the loan, right? At the title company. So you can close a loan, I mean, from start to finish. I mean, even as low as 30 days, maybe 20 days, just depends on the situation. So what are some tips for working with a lender? Be honest and disclose. Look at it like the lender, find somebody you're really comfortable with and treat them like your doctor, right? Hey, this is the situation. You know, I really want to buy a house. I've been working on this for a long time and they should be your consultant. My concerns are X, Y, Z. This is what's on my credit. This is what's going on with my financial life, etc. Put it all out there. That way, there's no surprises for when you're getting the loan, right? Because the worst thing could be if there's a surprise. And we're going to ask questions as the lender. My job is to try to ask and like know things ahead so I can plan for them and prepare. And that way, everything can just flow. They say one of the biggest things in life is buying a home. One of the most stressful things. I want to remove that. I want to take that away. I want to make it a simple, easygoing thing so it just flows, right? The other thing is we want to shop around. So you want to find somebody you're comfortable with, right? Someone that is honest, someone that's easygoing, right? Getting a loan, a lot of people can do it, right? But you want to find somebody you're comfortable with, someone that you trust, right? I highly recommend that. And then you can request, a loan estimate, so you can have an idea of the costs in advance. The other thing is ask questions. Right? You can, hey, how does this work? How does that work? Why are we doing this? Why are we doing that? Be informed. Be an informed borrower, because when you're an informed borrower, it's your lender can be more informed, can be more informative, because you're really informed. They're not like seeming that, hey, I'm gonna overwhelm you with information. Rather, I want to give you as much information as possible so you can prepare and you can plan accordingly. Listen to advice. So let's say, hey, the lender says, don't buy anything before closing. Don't make any big purchases. Listen, don't buy anything before closing. Wait till the deal's done. Then you can get your furniture. Then you can get anything else you needed. Like if you were going to buy a car or something like that, just wait. Because remember, you're buying $100,000 asset or bigger, right? So it's just a delicate point. Communicate timely. So typically, sometimes there's a delay in closings. We need certain documents. Hey, I know you're busy. Everyone's busy. Just try to work on it as soon as you can, right? Provide an answer as soon as you can. Doesn't have to be right away, same day. Could be the next day, but just, hey, we're working timely here. And then we're all on the same team, right? Okay, now let's talk about the real estate agent or the realtor. The realtor is the person who will help you find a home within your budget, right? They're going to educate you on the real estate market, right? They're going to tell you if it's a buyer's market, if it's a seller's market. The real estate agent is going to help you prepare the contract. They're going to submit offer for properties you want to buy. They're going to represent and negotiate on your behalf, right? So they're going to negotiate with the seller, the seller's agent. They're going to manage the inspection, right? They're going to help work with you. Hey, we're meeting the inspector at this day. The inspector's going to be here from this day to this time. We got to make the properties open. We're working on making sure the other inspector's there, make sure everything's ready to go. Any rules from the seller, coordinating everything. They're going to connect you with vendors. Hey, I need an AC person. Hey, I need a roofing person. Hey, they typically have a lot of relationships in the market that they can assist with and more. There's like a form of like a document of like 100, I think it's like 50 or 100 tasks that a real estate agent does with a realtor, right? So just be aware of that. Value your realtors. What is a buyer's market and what is a seller's market? We've heard this before. A buyer's market, the definition is it's 7 to 10 months of inventory, 7 to 10 months of houses. So if every month one house sells, right? And there's 12 months, right? So every month one house sells, there's 12 months. In about 12 months, the houses will be gone, right? So that's a bit of a buyer's market, probably even worse than a buyer's market, really extreme buyer's market. Call it even two. Let's just say some like a 1.5 houses, right? So in about 12 months, you have houses are selling a lot, right? So this type of market is in your favor. So you can take your time on deciding on what home to buy. You can make offers below the asking price, and you can make terms that are favor the buyer. So you can ask for seller credits. You can ask for seller concessions. You can say, hey, I want, an inspection period that is longer. Maybe typically it's 7 days, but you're like, no, I want 15 or 20 days. And then you're like, hey, look, the roof needs to be replaced, even though it's only 10 years old, but I want you to replace it. You can ask for a lot more things in a buyer's market. Now, in a seller's market, 0 to 5 months of inventory. So there's less houses on the market. The buyer's market, there's more houses. Seller's market, there's less houses. Didn't explain that well. Less houses in the seller's market. Buyers must make quicker decisions because when you go to a house, there's like 5, 10 other buyers there, right? So you want to make a quick decision. This is the house. This is the area that I want to be in. I like it. Let's go. Only pre-qualified or pre-approved buyers will win their house choice, and even sometimes cash buyers, right? So you want to be aware of that. So you got to move quick. You got to get pre-qualified, ready to go. And then the next one is offers need to be at or above asking price. Maybe they're asking 500,000, but you got to offer 510 to be competitive. You got to offer 515, 525, maybe even more, right? Depending on how extreme it gets. So just so you have an idea of the differences. Now there's different types of houses when you're buying. The most typical is a resale house. Call it a used home, kind of like a used car. Existing homes, been on the market, maybe 10 years, 20 years, 30 years old or more, right? Then there's new construction. The builder is the seller, right? So you're buying directly from the builder. Could be D.R. Horton, Lennar, Taylor Morrison, all these larger builders, you're buying from them. Realtors can help you with that as well, and I recommend that you hire one. And even consider a lender outside so you can compare with what they offer you. They typically offer some incentives for lending, but compare with someone like me. Hey, I'm being offered this. Can you compete? Just so compare both options. Short sales. So this could be probably a resale home, but it requires 2 approvals. The owner must accept the offer and the bank must approve the sales price. So this is the short sale route. And an REO is the bank took the property back. It's listed by a real estate agent, but it's from either the government or a local bank or a national bank, and it's called REO. It's a foreclosure. It's a real estate owned by the bank. Now, writing the offer. What's a strategy to writing the offer? You got to put an earnest money deposit. We talked about this before, and that's between 1 to 3% of the purchase price. If it's a $100,000 purchase, just using 2%, $2,000. If it's $500,000, it'll be $10,000, right? Easy math there. Contingencies. What is a contingency? It's something that in case I decide to change my mind because of any one of these things come back negative, I can get out of the contract, I get my money back, all right? Inspection, typically 7 to 15 days from the contract. So you have an inspection done you have 7 days to cancel the contract. So in 5 days, they do the inspection, and then they say, look, the roof needs to be replaced. You tell the seller, look, I'm canceling the contract. Are you guys willing to replace the roof? It's old, needs to be replaced. No, I'm canceling the contract based on the inspection because of the roof. right? Contingency, another one is appraisal. Maybe the property didn't appraise. It was for sale for 500,000. You offered 510. It only appraised for 450. You're like, hey, can you lower the price to 450? No. All right, I'm going to cancel the contract based on the lower appraised value. Make sure that you have those. Financing, typically 30 to 45 days, right? So you say, hey, I have 45 days to get financing. If you don't have it by then you can cancel the contract, get your money back. HOA or condominium documents, you review those. Something comes up in there that you don't like. You're like, oh, I'm not going to buy here. Sell your house. You're like, let's say you need to sell your house before buying this one. You can put that into the contract. Typically, if it's a buyer's market, you have more flexibility. You say, hey, I want to buy your house, Mr. Seller, but I'm not going to buy your house until I can sell my house. So are you willing to accept my offer based on that? And then the last one is title. Make sure the title comes clean. And that's more of a typical one where you don't want to have any problems with that. All right, so now what are some other team members? The attorney I already mentioned, they review the contract, they write the contract sometimes, they can handle the addendum. So these are some changes to the contract or some special pages, notes, items that maybe are not listed in the contract. This is kind of like extra stuff. And then they can review the closing documents for you. Make sure to review the loan documents, the note, the mortgage, all that stuff. Make sure it's done right. When you're buying a house, typically you're not going to have an attorney. You're on a budget. You're trying to save, so you're not going to hire somebody that you want to read some of these things. But hey, if you can afford it, I highly encourage it. $300-500 maybe, maybe 1,000, depending on the area, depending on how many documents. Great investment of money and time to learn and get things done right. Home inspector. It reviews the home condition. They look at all the systems. Like typically homes have 4 major systems. We have the roofing system, plumbing system, the electrical system, and the HVAC system, which is heat, ventilation, air conditioning. And they look at everything, make sure everything's operating properly. They're also going to look at the walls, make sure there's not any moisture, not any leaks. They're going to look at the wood, make sure that a little bit of wood rot. They may recommend another inspection that I'll list in a minute. So they're looking and they're going to estimate the life of the system. They say, hey, you may need to replace the plumbing in 5 or 10 years, right? If the home is older, maybe you need to say, they'll say, oh no, you still have 20 years. It's an estimate, but it gives you an idea because, if you don't work in construction, then you're not going to know. So it's a great investment of money. And then they provide the report. They may say, look, the house is in great condition. You don't have to worry about it. Or they may say, look, it has some minor items, $300 to $500. This is some things you can ask for the seller to pay, or you can just say, don't worry about it and you'll take care of it. If it's a buyer's market, you can ask the seller. If it's a seller's market, you're probably going to have to eat it yourself. But these are some things that the inspection kind of pays for itself, depending on the market. Wood destroying organism inspector, they're looking for termites, right? These are organisms that eat wood. It could be carpenter ants, other organisms like some special beetles, and they can identify if they have them, if they're live, or if maybe they're not live, they already made some damage, but now you can get a bond in case something else happens that they'll come and replace it, they'll come and retreat, right? There's 2 types of bond you can get. You can get a retreatment, just for them come and retreating everything. If they treated it once, if it comes back, or they can come back and repair, which is more expensive. We're in Florida, a lot of wood destroying organisms, so I wouldn't be scared. I just would be concerned if there's a major damage, right? So that's something, if it's a little bit of wood rot or a little bit of wood damage, I wouldn't consider a big deal. But if it's extensive, then at that point I would consider moving on. Make recommendations for treatment if necessary. Let the inspector make recommendations. This is, again, try to find someone that you can easily get along with, understand. You're relying on your real estate agency or probably your lenders to connect you with people, but make sure you shop around, talk to 2, 3 different people. People are easy to talk to. Remember, you're learning here. You want to make sure to feel comfortable, understand it's your investment. Rely on your partners, but remember, you're the decision maker. Lenders typically require clean inspection, no evidence, live or damage. And it costs somewhere between $100 and $300. The appraiser, right? They evaluate the home condition. How old is the home? How old does it look? They look for comparables? What have homes sold for in the area? That's a comparable, sales comparable. They look at pending homes. They look at active homes in the area, things that are for sale now. And then they assign 3 values. They look at the sales comparable approach, which is really how they're going to value the property. They look at if 3 homes sold in the area close by and similar to your home, they're going to probably say, hey, your home is worth what these homes sold for. They're going to look at the income approach. This is for typically for commercial real estate, for rental real estate, and then they're looking at the cost approach. The cost is how much it will cost to rebuild. This is used for insurance, All right. And then the last person is your insurance agent. They review the home inspection. They look at quotes for home insurance. They bind or approve the insurance right before closing, has to be approved. And then they provide the certificate of insurance, right? So you can close. The last person is really a title insurance agent, just call it a title agent. These are the people that they're handling all the closing documents. They're insuring the title, make sure you're going to own the property. And if something happens that John Smith pops up and says, no, that's my house, it shouldn't have been sold to you, they're going to insure and protect you, whether that is to keep the house or get your money back that you spent, etc. Typically, with the homework that they do, very rarely in a situation like that occurs, but it happens. So that's why you're getting that type of insurance. You pay for that at closing as part of your closing cost. So the title agent handles the settlement and disbursement of funds, which you pay the buyer, and the lender pays, then the seller gets. They issue the title insurance to protect your ownership, and then they file all the necessary paperwork with the city to record your ownership. So at the city, they know that you own the home. So beware of wire fraud. This is just a very important point. If someone called you from the title company, say, hey, I need you to send us $2,000. I need to send a $10,000. We're getting ready to close. I would wait. I would speak with the lender, and then I would even Google the number of the title company before, and then call them back, and then confirm that that's correct, that they need that money before sending any money, because tons like people are hacking people's emails. They'll say, hey, send us $10,000. Once you wire it, the money's gone. So just be aware of that. And then you close. And then, so review and sign all the documents. One of them is very important, is the promissory note. This is just your debt that you're saying you're signing for the mortgage, for the loan. Then there's a mortgage, which tells the bank if you don't pay, they can keep your house. There's a closing disclosure, which has all the cost in it. And then it has other closing documents, tons of pages. You're kind of signing a book here. Read through it, but just you're going to have some of this in advance. Try to have it, at least a couple days in advance, so you can have a quick look. So the day of closing, you just have to just give it a second look. You're already familiar with it. Don't just pop up there and you're like, oh my God, all these documents. Make sure to have them all then. Get your keys, transfer your utilities, and celebrate. Congratulations on your home. You're a homeowner. All right, so now if you're looking to get started, you're ready to go. Let's have an introductory phone call. All right, no commitments. Chat for 15 minutes. Hey, Danny, I've been thinking about home ownership. The market, concerns me, or this is my income. Let's just have a quick call, talk about your goals, talk about the process, your personal situation, and then we can kind of, I'll give you an idea of what your plan should be, what you should do to get on the path. Maybe now, maybe later, but hey, it's better to get on the path eventually, right? The next one is a consultation or a phone or video call. So this is a little bit longer, 30 to 60 minutes. We'll go more in depth on where your loan options are, your budget, other details of the loan process to get you pre-approved. So the goal of that call is to go from that to pre-approval. And then we should have your loan application before that. And we can do like a Zoom call if you're not, the easiest way to do that. All right. So in the free personal consultation, we'll do a understanding your housing situation. Where are you living at now? Where do you want to go? Establish your short and long-term goals for home ownership and investing, right? Because again, I'm an investor, so I'm really passionate about that too. Maybe you want to buy investment property. Would love to help you with that. Maybe start with home ownership, go to investment. Find a comfortable payment. We can talk about that. What's realistic, what's comfortable. Market search for your desired neighborhood. So we can kind of like search around, hey, this is my neighborhood I want to live. What should I be shooting for on house prices? I'm not going to represent you as your real estate agent per se, but I can go ahead and like look online for you and we can chat about that, like kind of look at some neighborhoods. Completing the loan application process, understanding interest rates and closing costs. So kind of give you a little bit of an education on what the market is doing and how it's going. Finding the right loan program. So we can kind of talk about what program may be best for you in your situation. Do a debt to income analysis so we can compare your debt to income and see where you fit there. Scope of the loan documents checklist. So we have a loan documents checklist. We can go over that. Get your pre-approval letter. And then talk about the benefits of partnering with a real estate agent. And then really, we're all partners, right? Because we're all on the same team. So I'm a partner with a real estate agent, and so are you. And I can help you find someone in your area, in your market, right? So thank you for taking the time, and I look forward to working with you. I hope this was beneficial and it give you a good idea of how you can be a homeowner. Give me a call. My number's on there. Send me an email. Easier to get through me to email, and then we can schedule a call there because phones are ringing. During this video, a couple calls came in. But I would love to help you get on the path to homeownership. This is something I'm really passionate about, helping people build wealth. So until then, I'm going to say take care, and I look forward to speaking with you. All right, take care. Bye-bye.